Okay, good morning. Good morning, members. Welcome to this meeting of Kirkcudbright Common Good Fund, the subcommittee. This meeting is being live streamed and will be recorded and made available on the council website for viewing. Members may notice when calling members to speak, I'll refer to them formally using their title, i.e. Councillor Smith, just so that it's clear who are the councillors and by the process of elimination who officers are. Remote participants, please follow good practice guidance, which includes muted microphones, switching off video when you're addressing the meeting, writing speak in the Teams chat function when you want to contribute. Please don't repeat contributions already made by other members. No material should be posted in the chat function that is intended as part of the discussion. The usual standing orders apply, including that any votes will be undertaken by roll call. If any member has to leave the meeting, please either leave the Teams meeting for that period of time or write leave in the Teams chat function and then join when you rejoin the meeting so we can keep track on whether the meeting is quoted. All members should speak clearly, taking their time and speaking directly into the microphone when making contributions. When referring to reports, please provide reference to the relevant page and paragraph. It means everybody can follow. Please focus on contributions in areas where clarification is required or to propose an alternative recommendation. Okay, so number one, if Gillian, can you provide the sediment indicating who's participating remotely and any apologies, please?
Certainly. So we've got councillors Dennerley, Campbell and McFarlane all participating online, and I haven't received any apologies for this morning.
Okay, that's great. Yeah, I can confirm my agreement to the participation of members named as participating remotely. So number two, declarations of interest. Do members have any statement of connection or declaration of interest to declare based on definition? So statement of connection, for transparency reasons, members may wish to make a public statement, or declaration of interest, members would now require to leave the meeting from that item. Anybody? Okay, great. Let's move to item 3, minutes of previous meeting, Wednesday, the 26th of June, 2024, for approval. Are members happy to approve that?
Happy to approve.
Thank you. Thank you, Dougie. Yep, and I see Andy's got his thumb up as well, so that's great. Thank you both. Let's move on to item number 4. So it's the only report today, and it's in relation to the Kirkcudbright Common Good investment approach. So we'd like to welcome David Hurston from Brew and Dolphin. He's with us to provide a presentation setting out the decisions that are required to be made by members to agree an investment approach. David, I'd like to hand over to you just to take us through the presentation, please.
Thank you very much. So for those of you who haven't spoken to before, my name's David Hurston. I work in the Scottish charity team at Brew and Dolphin. I have been with the company for 24 and a half years, and for the last 14 I've been just working with organisations similar to yourself, where there is a pot of money which is used for the benefit of a wider group of stakeholders, and so I suppose I'm a specialist in this particular area. So what I'd like to do this morning is to give you an update on how the investments have been doing, what's been going on in the world of stock markets, and then also just to agree the suitability of the approach that we are to take going forward. And so to aid with that, I have prepared a presentation pack, which I will now share. So just setting the scene at the start, we've got two charts on the first page here. The one on the left is stock markets over the last year, and then the one on the right is stock markets over the last 10 years. So the last year has generally been very positive. So you can see really from the end of November onwards, markets have been generally moving upwards, and the main catalyst for that was the better than expected inflation numbers in October and November. And that meant at the time that we were able to stop worrying about interest rates having to rise any further. And at that stage, markets moved on to start thinking about when interest rates were going to start coming down. So interest rates coming down is generally good for investment markets. It's good for economies. It's a stimulus, and markets have moved on really quite strongly since then. You will note on the right-hand side of the page that we have had a bit of a bump over the course of the last 6 weeks or so. It's quite a technical thing which happened here. But basically, there were a number of trades which international investors had put in place to benefit from an interest rate differential between Japan and America. That all unwound very quickly. And we did see this very sort of sharp V-shaped bounce that you can see there. We've already moved on from that and recovered most of the losses that we've seen. The green line at the top, the best performing market, is the S&P 500, which is the main index measuring American stocks, which have led the way higher. Other investment markets there you can see have performed pretty much in line with each other. So we've got Asia, the blue line is the UK market, and the black line is Europe. And then at the bottom, we've got the government bond market. And then on the right-hand side, it's worth just noting how much better the S&P 500 in America has been compared to everything else. And the main reason for that, in that market having done so much better, is its large weighting in technology stocks. So most of the world's big technology names are American. They have been growing quite substantially over the course of the last decade, which accounts for the US market having done so well. To give that some context, the proportion of the US market which is invested in technology companies is around 30%, 30, and here in the UK that figure is around 1%. So that is quite a substantial difference between the two markets. And again, over the last year, it has been the technology companies which have been driving the better performance in the US. So just moving on to look at the Kirkcudbright Common Good Fund, how things are set up at the moment. Our risk spectrum goes from 1 to 10, with 1 being the lowest and 10 being the highest. And the investments for the Kirkcudbright Common Good Fund are managed with reference to risk category 6. The time horizon, we understand that these are long-term investments. So we have a 10 years plus investment time horizon. The objectives we have, we want to generate income to help you fund your activities. And the secondary objective, you want that capital to grow so that it's protected against inflation over the long term. We don't have a specific income target, so it's just a general guide to generate income, and that income is paid out on a monthly basis. Although currently we are going through a period where there has been a change in bank accounts, I think, at the council. So we haven't paid out the income for a couple of months, but the paperwork in the background to get everything updated, I understand is taking place. And so we will pay out everything which is built up, and going forward it will go back to being paid out on a monthly basis. The portfolio is directly invested in the UK. So that means you've got company shares directly held. Outside the UK, we use what are called collective funds, which is where your investments are pooled alongside other investors, and then a third-party manager goes away and invests on your behalf. That is something that potentially we can chat about later in the chat, because there is another option to invest directly into the US and Europe, which will help to limit the overall costs for the fund. We don't have any investment restrictions placed on the investments, so no ethical restrictions or anything like that. And we don't currently have an investment policy statement in place. So just to give the risk a bit more context. So I mentioned that our risk scale runs from 1 to 10, 1 being the lowest and 10 being the highest. We offer investment management services to organizations like yourself between risk category 3 and risk category 8. So you can see there where risk category 6 sits. So it's broadly in the middle, slightly towards the upper end of the risk spectrum. So what that means in terms of the distribution between different asset classes, you have roughly 2/3 invested in stock markets, so more volatile investments, and then roughly 1/3 invested in diversifying assets, so things that are a bit lower risk, so things like fixed interest and alternatives, which give a bit more cushioning to stock market volatility. So in terms of the value of the portfolio, how that's changed in recent years, you can see that listed across the top of the page here. As at the 22nd of August, when this presentation pack was prepared, the value of the investment sitting at £936,853. So if you cast your eye along the page there, that's about as high as it's ever been. Which is nice to note that the portfolio has participated in the strength that we have seen over the course of the last few years. We've prepared various performance figures you can see there. So what we quote here is something called a total return. So that's a combination of the income which is generated and also the capital growth which is generated. So since your last year end, since the 31st of March, which is a relatively short time scale, we're up by 2.3%. Over the previous year to 31st of March 2024, the investments generated a total return of 10.4%. And you can see there the figures going back over 3 and 5 years. We've included a couple of comparators there. The best comparator is the ARC steady growth figures. So ARC stands for Asset Risk Consultants, and they are a firm which collates performance for organizations which are similar to yourselves. So other charity-like organizations with similar investment objectives and attitude to risk. So it's a comparison with peers, a real life comparison. And we've also included there risk category 6 as well. Along the bottom line, you can see there the income which is generated over the previous year. So last year we generated about £22,500. Looking forward, we expect to generate just over £23,000, which in terms of an income yield is 2.5%. And we've included there a number of other measures of income. So risk category 6 yield is 2.2. If we lend our money to the government today for 10 years, they give us 4% a year and give us our money back. Inflation currently sitting at 2.2%. And we've got the Bank of England base rate sitting at 5%. So I mentioned that risk category 6 has an associated asset allocation, and the more detailed asset allocation is broken down on the right-hand column of the page here. We have some flexibility within the mandate to tactically allocate relative to that. And you can see how the portfolio is currently distributed down the centre column. At the moment, we don't have any huge relative positioning in the portfolio. So we're broadly in line with the fixed interest weighting and the UK equities weighting as well. And indeed also the overseas equities weighting is pretty close to the benchmark. You will note, however, that we do carry quite a pronounced bias towards overseas equities. So roughly half the portfolio, just under half, is committed to international markets. And within that, the largest allocation is to North America. So 32.3% invested in US equities. If you cast your eye down the page, there's also there something called global investments. So these are funds which don't fit neatly into any of the geographic buckets that we've got there. The majority of that 4.1% is also invested in North American equities. So when you add that on, we do have quite a meaningful overweight position in North America, and that certainly helped performance over the course of the last year. We've got the alternatives there, diversifying assets, which is a combination of some absolute return funds, some gold, and some infrastructure. We've got some commercial property, and we've got a bit of cash at the moment. And as I said, that cash figure is maybe a bit higher than we would normally see, just on account of us holding a few months worth of dividends whilst we get the bank account sorted out in the background. So this is the individual stocks which have done best and worst over the course of the 12 months to the end of March 2024. The best performing investment you have is Admiral, the insurance company. So I'm sure if you'd renewed your car insurance recently, you might have noted just how much more expensive that's become. And Admiral has been very successful at pushing through these inflation busting car insurance premiums, and the share price has been rewarded on the back of that. We've then got two of your US holdings which have done well, reflecting that strength that I talked about in US equities. So Baillie Gifford American and Edgewood Select US Growth both offer exposure to US equities. We've then got Scottish Mortgage Investment Trust, which has nothing really to do with Scotland or mortgages, other than the fact that it's also managed by Baillie Gifford in Edinburgh. It's almost a unique investment. It takes a very, very long-term view in the way that it looks at companies. So it's seeking to identify the disruptors, the companies that will change the world in 10, 15, 20 years' time. They have been very successful at being very early owners of companies like Amazon and Tesla in the past, and it has been one of your better performers on this occasion. And then we've got Relx there, another UK business which has done quite well. On the right-hand side, Croda International has been the weakest performer. If we were to be looking at the figures here during lockdown, Croda would have been your best performer. If you don't know Croda, they're a very high quality chemicals business, and they manufacture a lot of the component parts which are the base materials which go into things like shampoo and moisturizer. They also manufactured one of the component parts of the Pfizer jab, Pfizer vaccine. And their sales, the company's sales, were flattered throughout the pandemic as governments around the world scrambled to secure supplies of the Pfizer jab. As we've come out of the pandemic, these governments have moved into a phase where they're using what they've already bought rather than buying new from the company, and so we have seen Croda sales figures not quite keeping up with the pace that they were growing during the pandemic, and so the shares have fallen back slightly. We've then got the renewables infrastructure group, HICL, and property, and the Aberdeen Property Fund. There has been an impact from higher interest rates over that period for these holdings. They remain very high quality investments. The underlying holdings are still of a very sound quality, and we get very nice incomes from these three holdings. When interest rates start to come down more meaningfully later in the year, I think we should see better performance from these holdings, but they were lower over the course of the previous 12 months. And then just since the end of March, a relatively short time frame we're looking at here, Aberforth Smaller Companies has done pretty well since the end of March, and we've also seen Aberdeen doing quite well since then. Haleon, Mercantile, and Invesco Asian. Problems at Croda have continued to some extent since then, but our analyst on the company is still very comfortable holding them for the long term. Diageo, the drinks business, Legal & General, and Ashtead slightly lower, but nothing which gives us huge cause for concern for the long term. when we are investing on your behalf, we do take into account environmental, social, and governance factors. So this is seeking to invest in companies which are not just good investments, but also good companies. And we've always said that we've done this, but we now have a tool which allows us to measure our portfolios and how they screen on environmental, social, and governance factors. So this is the report for the Kirkcudbright Common Good Fund. So you'll see that the portfolio has an ESG risk score of 20.87, which on its own probably doesn't mean a huge amount to you. But we've included there the FTSE All World Index as a comparator. So that's just all the companies in the world lumped in together. And when it comes to ESG risk, the lower the better. And you can see there that the portfolio does compare favorably with the headline indices. We're able to break that down into a bit more detail on the sort of center right of the page. So you can see that the vast majority of the assets within the portfolio sit in the medium and low risk buckets. And we do have some exposure to negligible and some exposure to high. You will note that there is a proportion of the investments which are not covered. So not everything in the portfolio gets an ESG risk score. So things like cash, gold, government bonds, these don't get ESG risk scores. So that's why that figure is not at 100% with everything getting an ESG risk score. So this is quite a new tool for us, but hopefully it's something which is of interest and gives some comfort that we are taking these important environmental, social, and governance factors into account when making investments on your behalf. Just to give that a bit more detail, again, we can break that down into the individual stocks, which contribute least and most to the overall ESG risk. So you can see your negligible risk holdings, RELCs and Tritax Big Box. And then on the right-hand side, perhaps not too surprising to see the two extractive industries there. So Shell, the oil and gas company, and Rio Tinto, the mining company, as being the companies that contribute most to the overall ESG risk. We're also able to measure the carbon intensity of the investments. So you can see on the lower left of the page, what we're measuring here is the tons of carbon dioxide emitted per $1 million of revenue. So you can see the portfolio emits 126.04 tons of carbon dioxide per $1 million of revenue, which again compares favorably with the benchmark, which we've included there, 207.43 tons of carbon dioxide per $1 million of revenue. So as I say, this is quite a new tool for us, but hopefully it's of interest and does give you some comfort that we are taking these things into account when managing your portfolio. So I've included a few slides here on markets. Inflation has been a terrible problem in recent years, but we are at a stage now where it is much more under control. So sitting now at 2.2% in the UK, having been significantly higher than that relatively recently. So the inflation beast does seem to have been tamed for now. We may see inflation pick up a little bit towards the end of the year. Certainly, the increase in the energy price cap is going to have an effect. So we may see it nudging up towards 3% before the end of the year. But certainly nothing like the problems that we had in the not too distant past. What this has meant is that central bankers now are able to start bringing interest rates down. The higher interest rates do seem to have done the job. And we have seen so far the European Central Bank and the Bank of England here bringing down interest rates, and we will see the US Federal Reserve bringing interest rates down at its next meeting. But interest rates are not going back to the sort of 0.5% level that they were at for many years after the financial crisis. They are likely to come down and find a much higher base, so probably around roughly 3.5% level here in the UK. But nevertheless, interest rates coming down is generally a supportive backdrop for investment. In terms of economic news, the economies of the world have generally been doing a bit better than we expected that we were going to do this year. So we've got here economic growth figures and expectations for economic growth this year and next year. So the most important number on the page really is the US growth figure for 2024. So there was some expectation we were going to see a recession in the US this year, but actually now that looks like a very unlikely event. So the US economy projected to grow by 2.3% this year, which is pretty good. The UK, even here, we are projected to grow this year and indeed to accelerate next year. Similarly, the Eurozone, we've got global economic growth there on the right-hand side at 3%, which is not too bad by historic standards. So interest rates coming down at the time when economies are continued to grow is generally quite good news. Politics has been influencing things quite a lot over the course of the last few years. Obviously, we've had our election here in the UK. From a market point of view, it hasn't really had that much of an impact. But obviously, the US is the biggest economy in the world, and the election there is ongoing, or the campaigning for the election is ongoing. November is a long time away. These numbers can change, but currently Kamala Harris is a marginal favourite to win in November. She hasn't come out with too many policies yet from an economic point of view, so she is at this stage a bit of an unknown, but it's going to be very close indeed. And I suppose it's one we'll just have to watch for the time being. From a purely market point of view, Donald Trump is generally deemed to be more pro-business. He took a lot of regulation out of particularly the banking and financial markets in America when he was in charge last time. But again, I suppose similar to here in the UK, there isn't a huge amount, I think, to pick between them in terms of their policies. And we don't expect that either outcome will derail the US economy and its growth expectations. So just in summary, recession risks have increased a little bit over the summer months, but we certainly think it's most likely that the economies continue to grow. There have been one or two slightly concerning signs in the US job markets, but some of the recent fears we think are overdone. Interest rates are likely to continue to come down as we go through the rest of the year. Clearly, risks still remain. What happens if the US job market doesn't do as well as we think? Geopolitics is a big consideration. Inflation reacceleration. What happens if earnings aren't quite as good as we expect? But in terms of investments, I think we're happy to be slightly overweight in equities. The US remains our favoured market. We have a preference for government bonds over corporate bonds, and that's reflected in the portfolio. We've got some gold there, which has done quite well, and underweight in absolute returns. And I think just taking everything into consideration, we are still reasonably constructive on the prospects for the portfolio as we go throughout the remainder of the year and into 2025. So I'll stop sharing at this stage. I'm very happy to answer any questions that any of you might have.
Thank you very much, David. And that was really clear explanation and presentation with detail. I'd like to ask any members if they have any questions for David at the moment. Okay, thank you, David. Oh, we have a hand up. Councillor McFarlane.
Thank you for that. I did want a hotspot, as I explained earlier, so I've been finding it a little bit intermittent. However, I'll try and get across this. Way back in that presentation, you said the yield that we had was 2.5%. I think you said CPI was running at 2.2%, but of course that's just the rate at the moment. Or is that the rate over the whole year? And also you said that Bank of England rates run at 5%. So does that mean that we're actually losing the value of the investment? Thanks.
So the 2.5% is just the income which is generated. There is also capital growth on top of that as well. So if we look at the year to the end of March 2024, the investments were up by just over 10%. So that would be a combination of roughly 2.5% from income, and then you'd had roughly 7.5% in terms of capital growth. So you are making money relative to inflation over that period.
Thank you. So I'd like to ask as well, I have a question as well, talking about the US election in November. Callum Harris, obviously if she wins, the expectation is obviously for her, but possibly if Trump is the favourite and he wins, what effect might that have on the economy? Will it have a negative or a positive effect on the UK economy?
So at this stage, we know a bit more about what a Trump presidency would look like than we know about what a Kamala Harris presidency would look like. Some of the detail on some of the economic policies hasn't been announced yet for the Harris camp. So that would be a little bit more of an unknown. Markets don't like uncertainty. In terms of Trump, he's very pro-business. As I said, he took a lot of regulation out the US system when last time he was in charge, and he often boasted about how well the S&P 500 performed when he was president. Taking credit, I suppose, for what all these companies were doing, even though it didn't really have a huge amount to do with what he was doing. So I think on balance, probably a Trump presidency is probably slightly better for the US market and for the US economy. And if the US economy does well, generally that's good for all economies, including the UK. The US economy is the biggest and most important economy in the world. And as I said, if it does well, it tends to bring up other economies with it. And if it does badly, it does tend to have an impact on other international economies as well. So it's not a huge difference between the two, but I think from a purely business and market point of view, Donald Trump is probably a marginal favourite.
Thank you very much, David, for that. And members, we now move to recommendations. So 2.2, and note that the decision from the presentation and any questions or comments before we move on to the final recommendations, just to ask the members. Okay, so I'd like to ask the members for 2.1, we received a presentation from Bruin Dolphin setting out the decisions for the members in agreement of the investment approach, and for 2.2 to note the decisions on investment and that will be required to be made following the presentation by Bruin Dolphin. Are the members happy to agree the recommendations? Thank you, members. So now we'll move on to number 5, any other business deemed urgent by the chairman due to the need for a decision. So I have no other urgent business. Thank you very much for all your contributions today. Thank you. Bye-bye.
Bye-bye.
Thanks, Chair.
And thank you, David, as well.